Hello, everyone. When you first step into the market, you probably hear and read a lot about trading psychology. Phrases like be patient or stay disciplined are repeated everywhere. But I know for many people, they are just familiar words, not something you truly understand until you've lived through real trading experiences. In reality, patience and discipline are not abstract concepts. They are the lifeline that keeps you standing strong in the middle of the market's chaos. I have personally lost opportunities and money simply because I lacked these two qualities. And it was only after learning how to build patience and discipline that I started to find consistency in my trading. Today, I want to share with you 5 practical steps. Steps that I've applied myself and paid the price to learn. That will help you become more patient and more disciplined on your trading journey. Step 1. Slow down and respect the market's rhythm. When most traders enter the market for the first time, their instinct is to move fast. They want to open positions, chase every signal, and prove that they can make money quickly. I know this feeling all too well because I was once exactly the same. Every flicker of a candlestick seemed like an opportunity. Every headline in the news felt urgent. I was constantly glued to my screen, afraid that if I did not act right away, I would miss the trade of the year. But here is the hard truth. The market does not reward speed, it rewards timing. And timing can only be mastered when you slow yourself down and begin to respect the natural rhythm of the market. Think of the market like the ocean. No matter how strong a swimmer you are, you cannot fight against the waves. You cannot demand the tide to come in faster, nor can you stop it from pulling back. If you try to force the ocean, you will exhaust yourself and eventually sink. The market works the same way. It has cycles of expansion and contraction, volatility and calm, trends and ranges. To survive and thrive, you must first learn to slow down and observe those cycles rather than rush to fight them. Why rushing destroys patience and discipline? Impatience in trading usually comes from the desire to be in control. You want results now. You want your account to grow today. You want the market to reward you immediately for your hard work and your courage to risk money. The problem is, the market does not operate on your schedule. When you impose your expectations on it, you end up forcing trades that do not meet your criteria, ignoring risk management rules, and closing positions too early or too late out of fear or greed. I remember one particular day early in my trading journey when I had been sitting in front of the charts for hours, frustrated that no perfect setup had appeared. Finally, out of boredom more than conviction, I entered a trade that I knew in my heart was weak. Within minutes, the market moved against me, and I lost what had taken me days to earn. That moment taught me a painful lesson. Impatience is expensive. Every forced trade is like paying tuition to the market, and the market always charges a high price. Discipline collapses when impatience takes over. The trading plan that you carefully wrote down suddenly feels restrictive. The stop loss you promised yourself you would respect suddenly feels negotiable. The urge to just do something drowns out the calm, logical voice of reason. And once you break your rules once, it becomes easier to do it again. Before you know it, discipline is gone, replaced by impulsive decisions and regret. Slowing down to align with market rhythm. The first step toward building patience and discipline is to consciously slow down. This does not mean you stop trading completely or miss every opportunity. It means you shift your focus from reacting to every tick to observing the bigger picture. One practical exercise I often recommend is this. Before you even think about entering a trade, spend time just watching the market. Open your charts and simply observe. Notice how price moves during different times of day. Watch how it reacts to major support and resistance levels. Pay attention to how volume changes during sessions. Write these observations down in a journal. This process of watching without acting trains your brain to become comfortable with waiting. At first, you will feel restless. You will want to click that buy or sell button. But over time, you will begin to see patterns that you missed before. You will start to notice that certain setups repeat themselves only under specific conditions. You will realize that trading is not about constant action, but about waiting for the right alignment. This practice also teaches you to respect the rhythm of the market. Just as a musician must listen to the beat before joining in, a trader must listen to the market before committing capital. When you trade in harmony with the market's rhythm, your decisions feel less forced, your confidence grows, and your discipline naturally strengthens. The psychology behind slowing down. From a psychological perspective, slowing down is about shifting from a reactive mindset to a deliberate one. The human brain is wired for immediate gratification. In trading, that means you feel a rush of dopamine every time you click the button to enter a trade. It feels good to take action, even if the trade is not logical. That is why many new traders overtrade. They are addicted to the act of trading rather than the process of winning. By forcing yourself to slow down, you interrupt this cycle. You replace impulsive action with mindful observation. Instead of chasing the dopamine hit, you begin to value clarity, patience, and logic. Over time, your brain rewires itself. You start to crave well-structured trades rather than random entries. You begin to associate satisfaction not with constant action, but with executing your plan correctly. This shift is powerful because it directly strengthens your discipline. Discipline is not about willpower alone. It is about creating habits and mental associations that make good decisions feel natural. Slowing down is the foundation of that habit. Practical techniques to apply. Step 1. Let me share a few practical techniques that help me implement this step. 1. Set a waiting rule. Promise yourself that you will not enter a trade within the first 30 minutes of opening your platform. Use that time to analyze, review your plan, and observe market behavior. This rule alone will filter out many impulsive trades. 2. Use higher time frames. Beginners often get lost in 1-minute or 5-minute charts where price movements look chaotic. By switching to 1-hour or 4-hour charts, you are forced to slow down. Each candle takes longer to form, giving you more time to think and reducing the urge to overtrade. 3. Journal before you trade. Before every entry, write down why you are taking this trade, what conditions are met, and where your stop loss and target are. If you cannot clearly justify the trade on paper, you probably should not take it. The act of writing slows you down and brings logic into the decision. 4. Practice simulated patience. Pick a trading day where your only goal is to observe without placing a single trade. At the end of the day, write down the setups you would have taken and analyze how they played out. This builds patience like a muscle. 5. Remind yourself of the cost of impatience. Print out a screenshot of your worst impulsive trade, the one that hurt the most. Keep it near your desk. Every time you feel the urge to force a trade, look at it and remember the price of impatience. Personal reflection. When I look back at my journey, slowing down was the turning point. Before, I was constantly chasing the market, always anxious, always overtrading. My account balance reflected that chaos. Once I learned to respect the rhythm of the market, everything changed. I still took losses, of course. Losses are part of trading, but they were no longer the result of recklessness. They were controlled, planned, and acceptable. More importantly, my wins started to compound because they were based on patience and discipline, not impulse. Slowing down also brought me peace of mind. Trading stopped feeling like a frantic race and started to feel like a structured profession. I could close my platform at the end of the day without regret, knowing that I had followed my rules. That sense of calm is priceless, and it all begins with step 1, slowing down. Closing thoughts for step 1. If you take only one thing from this step, let it be this: the market will always be there tomorrow. Opportunities do not vanish forever, but your capital can vanish if you rush. Slow down, align yourself with the market's rhythm, and you will naturally cultivate patience and discipline. Remember, trading is not about how many trades you take. It is about how well you take them. And the foundation of every well-executed trade is the patience to wait for it and the discipline to manage it correctly. So before moving on to the next step, commit to this practice. Slow down. Watch the market without rushing. Learn its rhythm. Once you do, you will find that patience and discipline are no longer something you force yourself to have. They become a natural part of how you trade. Step 2. Build a trading routine that anchors you. When traders talk about discipline, they often picture strict rules, rigid checklists, or mechanical systems. While those things matter, discipline is not only about following rules. It is also about building a structure around your trading life. That structure comes in the form of a daily routine. A trading routine is not glamorous, but it is the anchor that steadies you when emotions and impulses try to push you off course. I want to be very clear here. Without a consistent routine, discipline will always feel like a battle. You will constantly wrestle with temptations, question your own decisions, and waste mental energy trying to improvise. But when you have a routine, you free yourself from 1,000 small choices every day. You know what to do, when to do it, and how to approach each situation. That clarity is what allows patience and discipline to actually take root. Let me take you back to my early days of trading. At that time, I thought freedom meant waking up whenever I wanted, turning on the charts, and hunting for trades whenever the mood struck. It felt exciting for a while, but soon I realized that this freedom was nothing more than chaos. Some days I would overtrade because I had been staring at the screen for hours. Other days I would miss opportunities because I overslept. There was no consistency, no structure, and as a result, no progress. It took me years to understand that professional traders do not chase freedom, they build discipline through routine. Just like athletes have training schedules and musicians have practice rituals, traders need their own process that prepares them mentally, emotionally, and technically for the market. The power of preparation. A proper routine starts before the trading session even begins. For me, this preparation became a game changer. Instead of jumping into the market blind, I now begin each day by reviewing the bigger picture. I look at the overall market sentiment, check important news events, and analyze key levels on multiple time frames. This is not just about information. It is about putting myself in the right state of mind. Think of it like an athlete warming up before a game. You cannot expect to perform at your best if you show up cold and unprepared. By starting with a clear analysis and a calm mindset, I give myself the best chance to stay patient and wait for my setups. The routine reminds me that trading is a process, not a gamble. Defining your trading hours. Another crucial part of a routine is setting your trading hours. Many new traders believe they should be in the market all day, constantly searching for trades. That is one of the fastest ways to burn out and destroy your discipline. The truth is, quality opportunities usually cluster around certain times of the day, depending on the markets you trade. For example, in forex, volatility often peaks around the London and New York session overlap. In stocks, the first and last hours of the trading day tend to be the most active. Once I identified the times when my strategies worked best, I locked those hours into my routine. This change alone transformed my discipline. Instead of being glued to the screen all day, I limited my trading to specific windows. This gave me structure, reduced fatigue, and removed the temptation to chase setups at random times. Creating a pre-trade checklist. One of the most powerful tools I added to my routine was a pre-trade checklist. Before I place a trade, I go through a series of questions. Does this setup align with my trading plan? Is the market environment favorable for this strategy? Am I risking an amount I am comfortable with? Is my mind clear? Or am I trading out of boredom or revenge? At first, going through this checklist felt like a chore, but soon I realized it was my safeguard against impulsive decisions. Each question forced me to pause and think, which naturally cultivated patience. Discipline stopped being about willpower. It became about following the process I had already designed. Incorporating breaks and reflection. A healthy routine also includes moments of rest and reflection. I used to believe that sitting in front of the charts all day made me more dedicated. In reality, it just made me more emotional and less objective. Now, I schedule breaks into my routine. If I am not in a trade, I step away, stretch, walk, or even meditate for a few minutes. These breaks refresh my focus and prevent emotional buildup. They also remind me that my job as a trader is not to be constantly active. My job is to make good decisions. A calm, rested mind is far more disciplined than an exhausted one. At the end of each session, I also dedicate time to reflection. I review my trades, note what went well, and identify mistakes. This simple habit helps me reinforce discipline because it connects my daily actions to long-term learning. Without reflection, it is easy to repeat the same errors. With reflection, each mistake becomes a lesson that strengthens patience and consistency. The psychological benefits of routine. Some traders underestimate how much a routine shapes their mindset. For me, the biggest shift was emotional stability. When I had no routine, my mood rose and fell with every trade. Wins made me euphoric, losses made me reckless. But once I built a structure around my trading day, I stopped feeling like a victim of the market's randomness. Routine gave me control. I knew what time to start, what steps to follow, and when to walk away. This predictability reduced anxiety and helped me stay calm, even during losing streaks. And when you are calm, you are more patient. You no longer feel desperate to force trades. You wait, you observe, and you act only when your criteria are met. That is true discipline in action. Customizing your own routine. I want to emphasize that your routine does not have to look exactly like mine or anyone else's. The key is to design something that matches your lifestyle, your market, and your personality. If you trade part-time, your routine may be shorter and focused on a specific session. If you are full-time, you may include more detailed preparation and post-market analysis. The important thing is consistency. Whatever routine you choose, commit to it. Follow it daily until it becomes automatic. Discipline is not about forcing yourself to do things you hate. It is about creating habits that support your trading goals. Once your routine becomes second nature, patience follows naturally because you are no longer rushing or improvising. Discipline without routine is fragile. Let me end this step with a hard truth I learned the painful way. Discipline without routine is fragile. You can promise yourself to be patient, you can write motivational quotes on your desk, but when the market tempts you with sudden moves, those promises often collapse. A routine is what protects you in those moments. It is your safety net, your structure, your anchor. With a strong routine, you do not need to rely on willpower alone. The process itself carries you forward. So, if you truly want to build patience and discipline, do not just tell yourself to be disciplined. Build a routine that makes discipline inevitable. That routine will become your foundation, the quiet strength behind every decision, every trade, and ultimately, your long-term success. Step 3. Create a structured trading plan and follow it relentlessly. One of the greatest downfalls of many traders, especially in the early stages, is entering the market without a clear plan. They rely on instinct, on emotions, or on random signals they find online. The result is usually the same: inconsistency, frustration, and a gradual erosion of both capital and confidence. To cultivate patience and discipline, you must establish a well-structured trading plan that defines your actions before you even place a single order. A trading plan is more than just a set of entry and exit rules. It is the blueprint of your behavior in the market. It should clearly answer critical questions such as, when do you enter a trade? What must the chart show you before you take action? Where will you set your stop loss and your profit target? How much of your capital will you risk on this trade? Under what conditions will you avoid trading altogether? By addressing these questions in advance, you strip away the ambiguity that often causes traders to act impulsively. Patience grows naturally from a structured plan because you know exactly what you are waiting for. Instead of chasing every price move, you are guided by the clarity of your rules. If the conditions are not met, you do nothing. This is where many traders fail. They feel that doing nothing means missing out. In truth, doing nothing is often the most powerful expression of discipline. The market rewards clarity, not desperation. Think of a trading plan like a contract you sign with yourself. Every time you open a position, you are either honoring that contract or breaking it. The more consistently you honor your own rules, the stronger your self-control becomes. Discipline is not about perfection, but about commitment. Each trade is an opportunity to prove to yourself that you are capable of following through. Over time, this builds trust between you and your system. And with that trust comes the confidence to stay patient even when the market tests you. It is also important to keep your plan realistic and aligned with your personality. Some traders thrive in fast-moving environments, like scalping, while others prefer the slower rhythm of swing trading. There is no universal plan that works for everyone. If you force yourself into a strategy that does not suit your temperament, your patience will quickly erode. For example, if you are naturally cautious and prefer deep analysis, day trading might feel stressful and push you toward impulsive mistakes. On the other hand, if you enjoy quick decision making and cannot stand holding positions overnight, then longer term strategies may feel suffocating. Your plan must reflect not only the market, but also who you are as a trader. Following your plan relentlessly does not mean you will never adjust it. Markets evolve, and your understanding will deepen with experience. The key is to only make adjustments after a careful review and testing period, not in the middle of a trade. Too many traders sabotage themselves by changing their plan on the fly as emotions surge. They move their stop loss farther away to avoid taking a loss. They close trades prematurely out of fear of losing profits. They add to losing positions in the hope that the market will turn. Each of these decisions might feel justified in the heat of the moment, but in reality, they are all symptoms of a lack of discipline. The trading plan is there to protect you from yourself in those very moments. Another critical part of having a structured plan is risk management. Discipline is not just about when to enter and exit, but also about how much to risk. If you risk too much on a single trade, emotions will inevitably take control. Fear and greed become amplified when too much is at stake. A solid plan ensures that every trade is just one of many, not a do or die gamble. By limiting risk consistently, you free your mind to focus on execution rather than survival. Patience and discipline also require accountability, and this is where journaling becomes an extension of your plan. Every trade should be recorded, not only with numbers, but with notes about your mindset, your reasoning, and your emotions. Reviewing this journal regularly allows you to see whether you are truly following your plan or simply convincing yourself that you are. It is easy to rationalize mistakes in the moment, but when you read your notes later, the truth becomes clear. This self-awareness strengthens your resolve to remain disciplined. Consider this. Professional traders do not approach the market with casual spontaneity. They have systems, processes, and checklists. Airline pilots do not improvise takeoff procedures. Surgeons do not rely on gut feeling in the operating room. They follow structured protocols because the cost of mistakes is too high. Trading may not involve physical life and death, but financially and psychologically, the stakes can be just as serious. If you want to be treated like a professional, you must act like one. And, and that starts with a trading plan that you respect unconditionally. Finally, understand that the act of following a plan is itself a form of training. Every time you resist the urge to deviate, you are strengthening the muscle of discipline. Every time you wait for your setup instead of forcing a trade, you are teaching yourself patience. These qualities are not gifts you are born with. They are habits you build through repetition. Just like physical exercise, the more you practice sticking to your plan, the stronger your discipline becomes. Over time, patience will feel less like a struggle and more like second nature. So if you want to take a serious step toward mastering patience and discipline, create a trading plan that is detailed, realistic, and personal to you. Then follow it with relentless consistency. Do not allow emotions to rewrite your rules in the heat of the moment. Trust the process you have built. In doing so, you will transform from a reactive trader who chases the market into a disciplined professional who waits for the market to come to you. And that transformation is what separates those who survive in trading from those who eventually walk away. Step 4. Mastering emotional control to strengthen patience and discipline. One of the biggest challenges every trader faces is learning to control emotions. The market is unpredictable and full of ups and downs that can quickly trigger feelings of fear, greed, frustration, or even overconfidence. These emotions often push traders to act impulsively, breaking their own rules and abandoning the discipline they worked so hard to build. Without emotional control, patience fades quickly and decisions become reactive rather than strategic. When traders are caught in an emotional spiral, the effects can be devastating. Fear can cause you to cut winning trades too early because you are afraid of losing unrealized profits. Greed may tempt you to add to a position recklessly or chase after a trade that does not fit your strategy. Anger and frustration can lead to revenge trading, where you try to win back losses immediately without thinking. Overconfidence, on the other hand, might push you to take oversized risks because you start to believe you cannot be wrong. Every single one of these emotional traps undermines patience and discipline, and sooner or later, they drain your account. The first step in mastering emotional control is self awareness. You cannot manage what you do not recognize. Begin by observing your emotions during trades. Notice how you feel when the market moves against you or when you hit a string of wins. Do you feel anxious, restless, or overly excited? Writing these feelings down in a journal helps bring them into focus. This awareness alone creates a space between your emotions and your actions, allowing you to pause before reacting. Another powerful way to manage emotions is to establish predefined rules and commit to them. For example, decide in advance how much you are willing to risk per trade, where your stop loss will be placed, and under what conditions you will enter or exit a trade. By setting these boundaries before emotions get involved, you reduce the likelihood of making impulsive decisions. When fear or greed tries to push you into breaking your plan, remind yourself that your rules exist to protect you from exactly these situations. Mindset also plays a critical role in emotional control. Many traders attach their self-worth to the outcome of a single trade. When they win, they feel brilliant. When they lose, they feel like failures. This emotional roller coaster drains patience and weakens discipline. The healthier approach is to detach your identity from individual trades and instead focus on the long-term process. A loss does not define you as a trader. It is simply part of the game. Patience becomes easier when you understand that trading is about probabilities and consistency, not perfection. Practicing techniques like deep breathing, mindfulness, or even short breaks away from the screen can help calm emotions in real time. If you feel anxiety rising during a trade, take a few slow breaths and remind yourself of your plan. If frustration builds after a losing streak, step away from the charts for a while rather than forcing another trade. These small practices may seem simple, but they make a huge difference in keeping emotions under control. Risk management is another key component of emotional stability. If you consistently risk too much on trades, even small market moves will cause extreme emotional swings. By keeping risk per trade small and manageable, you remove the pressure that triggers fear and greed. When the worst case scenario is a loss you can easily handle, emotions lose much of their power over you. This makes it easier to stay patient and stick to your discipline, no matter what the market does. Over time, mastering emotional control becomes a cornerstone of professional trading. It does not mean you stop feeling emotions. That is impossible. But it does mean you learn not to let those emotions dictate your decisions. The market will always test your patience and discipline, but when you have the ability to control your reactions, you put yourself in a position of strength. By cultivating awareness, following predefined rules, managing risk, and developing a healthy mindset, you transform emotional control from a weakness into an asset. Patience stops being something you have to force, and discipline stops being a struggle. Instead, they become natural byproducts of a calm, focused state of mind. This is the kind of mental foundation that allows traders to survive in the long run and eventually thrive in the markets. Step 5. Cultivating patience through meditation and mindful practice. When traders talk about patience, most people think of simply waiting for the right setup or holding on to a trade until it reaches the target. But true patience runs much deeper than that. Patience is not just about the clock or the calendar. It is about the state of your mind while you wait. Are you calm and centered? Or are you restless, anxious, and fighting the urge to jump into action? The truth is, if your mind is restless, you will eventually sabotage yourself no matter how many times you remind yourself to be patient. That is where meditation and mindfulness come into play. Meditation is often misunderstood in the trading world. Some think it is about religion or spirituality. Others imagine it as sitting cross-legged in silence for hours. But in its simplest and most practical form, meditation is nothing more than training your mind the way you train your body at the gym. Just as lifting weights builds strength in your muscles, meditation builds strength in your attention, focus, and self-control. Think of your brain as a muscle. Every time you resist the temptation to click buy or sell impulsively, you are using that muscle. And just like physical muscles, the more you train it, the stronger it gets. Without training, it remains weak and your emotions dominate. Meditation is the training ground where patience and discipline are built before you even sit in front of the trading screen. One of the biggest challenges traders face is overthinking. You stare at the chart, your mind races with scenarios. What if the price breaks this level? What if I miss the move? What if I enter now and it reverses? This mental chatter is exhausting. Meditation teaches you to notice those thoughts without being controlled by them. You learn to step back and see that a thought is just a thought. It does not demand action unless you choose to act. That separation between thought and action is the foundation of patience. A simple meditation practice for traders is mindful breathing. Each morning, before you open your trading platform, sit in a quiet place. Close your eyes and focus on your breath. Inhale slowly, feel the air entering your body, then exhale gently. Thoughts will come. You may think about yesterday's trade or today's plan. Do not fight the thoughts. Simply notice them, label them as thinking, and return your focus to your breath. Even 5 or 10 minutes of this practice daily will strengthen your ability to remain calm during trading. Some traders dismiss this practice as too simple or unrelated to trading. But let me tell you from experience, when your heart is pounding after entering a position and the market starts to swing, your mind will not magically calm down. It will react the way you have trained it. If you have trained your mind to return to the breath, to stay grounded in the present, you will be able to handle the chaos without losing patience or breaking your rules. Meditation also helps you deal with losses. Every trader knows the pain of taking a loss, but not every trader knows how to recover mentally. Some become angry, some try to get revenge on the market, and some freeze and miss the next opportunity. Through meditation, you learn to observe the feeling of loss without identifying with it. You might feel frustration, disappointment, or even fear. But with mindfulness, you notice, this is frustration, this is fear. You separate yourself from the emotion, and in that separation, you find space to choose discipline over impulse. Another practical tool is visualization. After your breathing practice, you can visualize yourself trading with patience and discipline. Imagine sitting at your desk, waiting calmly for your setup. See yourself passing on trades that do not meet your criteria, even when they look tempting. Picture yourself closing your platform when your plan says to stop, even if you feel the urge to continue. Visualization is a mental rehearsal, and it strengthens the neural pathways that support discipline in real time. It is important to understand that meditation is not a quick fix. Just like building physical fitness, it requires consistent practice. At first, your mind will wander every few seconds. You might even feel more restless because you finally notice how busy your mind really is. But that awareness itself is progress. Over time, you will find yourself calmer, not only in trading, but in daily life. You will have more patience with people, with situations, and most importantly, with yourself. Some traders prefer formal meditation, while others practice mindfulness informally. For example, you can practice mindfulness while drinking your morning coffee. Instead of scrolling your phone, just sit and focus on the aroma, the taste, the warmth of the cup in your hand. This simple act trains your brain to be present. Later, when you watch the market, you bring that same presence into your trading. You stop chasing every candle and instead observe patiently, waiting for the story of the market to unfold. There is also a link between meditation and managing stress hormones like cortisol. Scientific studies show that meditation lowers stress levels, improves focus, and increases emotional resilience. For traders, that means fewer impulsive decisions and more consistent execution of the plan. While other traders burn out under pressure, you remain centered and steady. That steadiness is a competitive edge in a profession where most fail because of psychological weaknesses, not lack of technical knowledge. Patience, in the end, is not about waiting. It is about how you wait. Are you waiting with tension, constantly checking the screen, doubting yourself, and looking for shortcuts? Or are you waiting with calm confidence, grounded in the knowledge that your edge will play out over time? Meditation teaches you the second way. It transforms waiting from a struggle into a natural part of your rhythm as a trader. To tie this step together, let me share something personal. In my early years, I was always restless. I could not stand waiting. Even when my plan said sit out, I would find an excuse to trade. I thought discipline was about forcing myself not to act, but I would always lose that battle eventually. It was only when I started practicing meditation, just a few minutes a day, that something changed. I began to notice the urge before it took over. I realized I had a choice. Slowly, I became the kind of trader who could wait hours, even days, without anxiety until the market offered me what I was looking for. That patience became my edge, more valuable than any indicator or strategy. So, my advice is this: do not underestimate the power of meditation. Do not think of it as soft or unnecessary. In trading, your mind is your most important tool. You can have the best strategy, the best technology, and the best market knowledge, but if your mind is restless, you will sabotage yourself. Meditation is how you sharpen that tool, how you cultivate patience and discipline at the deepest level. Start small, 5 minutes a day. Breathe, observe, return to the present. With time, you will notice the difference. You will no longer be the trader who chases the market out of impatience. You will be the trader who waits calmly, acts decisively, and executes with discipline. That is the kind of trader who survives and thrives in the long run. Step 6: journaling your trades to strengthen patience and discipline. When traders talk about tools, most beginners immediately think of charts, indicators, or sophisticated software. Yet, some of the most powerful tools in trading do not come from a broker's platform or an advanced algorithm. Instead, they come from something deceptively simple: a notebook and the act of journaling. At first glance, keeping a journal may not sound as exciting as spotting the perfect breakout or riding a long trend. Many dismiss it as busy work, something that takes time away from real trading. But ask any seasoned trader, and they will tell you that a detailed trading journal is not just a record of past trades. It is a mirror of your mindset, your habits, and ultimately, your discipline. More importantly, it is one of the most practical ways to cultivate patience and consistency in a market that constantly tests both. Why a trading journal builds patience. Trading is a fast-paced activity. Markets move quickly, and emotions surge even faster. Without realizing it, you may find yourself clicking the buy or sell button impulsively, just because you are bored, anxious, or afraid of missing out. These moments rarely come from a well-thought-out strategy. Instead, they come from impatience. A journal forces you to slow down. When you commit to recording every trade, the reasons for entering, the rules you followed or ignored, the emotions you felt, you create a space between action and reflection. This pause alone builds patience. You stop seeing trades as isolated events and begin viewing them as part of a long-term process. Instead of rushing, you learn to wait because you know every decision will face the scrutiny of your own pen. How a journal reinforces discipline. Discipline in trading often sounds like an abstract idea. Stick to your plan. Follow your rules. Be consistent. A journal transforms this abstraction into something concrete. Each entry becomes a piece of evidence. Did you follow your stop loss, or did you move it out of fear? Did you take profits at your target, or did greed convince you to hold longer? By recording the truth of your actions, you can no longer hide behind excuses. You either followed your system or you did not. Over time, seeing these patterns in black and white is a powerful motivator. Traders who consistently write down their trades quickly realize that the pain of documenting mistakes is far greater than the momentary thrill of breaking their own rules. The journal becomes an accountability partner, a silent mentor that always tells the truth. What to include in a trading journal? To maximize the benefits, your journal should go beyond numbers. Of course, you want to record the essentials: the date, the instrument traded, your entry and exit price, your position size, and your profit or loss. But the deeper value comes from adding qualitative details. Ask yourself, why did I take this trade? Did I follow my strategy's entry criteria? How did I feel before, during, and after the trade? Did I exit because of my rules or because of emotions? What could I have done differently? These reflections reveal the real drivers behind your results. A winning trade taken out of impulse may look good on your account today, but it exposes a lack of discipline that could lead to heavy losses tomorrow. Likewise, a losing trade that followed every rule is not a failure. It is a success in discipline, one that reinforces patience for the long run. Spotting impatience in your journal. One of the most enlightening aspects of journaling is how clearly it exposes impatience. When you flip through your records, patterns begin to emerge. Entering too early, Did you jump into trades before your signal was confirmed? Exiting too soon? Did you close positions at the first sign of movement instead of letting your strategy play out? Overtrading? Did you take multiple unnecessary trades in a single day just to do something? When these tendencies are written down, they lose their ability to hide. You can no longer convince yourself that it was just this one time. Instead, you see the recurring habits that cost you money. This awareness is the first step to correction. Building patience through reflection. The act of writing your thoughts does more than record them, it organizes them. By revisiting your past trades, you gain perspective. A loss that once felt catastrophic may now look insignificant compared to the larger pattern of your performance. A winning streak that boosted your confidence may reveal that you ignored key rules. Reflection reduces the emotional intensity of individual trades and shifts your focus toward the bigger picture. Over time, you begin to see that successful trading is not about winning today or tomorrow. It is about playing the long game. This perspective naturally breeds patience. You stop feeling the need to force trades every day because you realize that discipline over months and years is what creates true profitability. Journaling as a form of meditation. In many ways, journaling is trading's version of meditation. Both require stillness, awareness, and honesty. Just as meditation helps calm the mind by observing thoughts without judgment, journaling calms your trading by observing actions without distortion. The practice itself becomes a ritual, a grounding habit that separates impulsive behavior from intentional decisions. Some traders even combine the two practices, journaling right after a short meditation. This creates a powerful cycle. Meditation clears the mind, journaling records the truth, and together they reinforce patience and discipline. Long-term benefits of a journal. The greatest traders in history did not reach their level of mastery overnight. They built it, trade by trade, lesson by lesson, documented and studied over time. A trading journal is not just a record, it is a map of your growth. Months later, you can revisit your early entries and see how far you have come. Years later, you can track the evolution of your mindset, your system, and your consistency. This long-term perspective is invaluable. It shows you that progress is possible, that discipline compounds, and that patience pays. Instead of relying on memory or feelings, which are often distorted, you rely on facts. Your journal becomes your personal textbook, filled with lessons written in your own experience. Making journaling a non-negotiable habit. For a journal to truly build patience and discipline, it cannot be optional. Many traders start with enthusiasm, only to abandon the practice after a few weeks. The reason is simple: it feels tedious. But here lies the lesson. Discipline is not about doing what is fun, it is about doing what is necessary. The key is to make journaling simple and consistent. It does not have to be a lengthy essay after every trade. A few sentences can be enough, as long as you are honest. The habit matters more than the format. Commit to it as non-negotiable, the same way you would commit to setting a stop loss or managing your risk. Closing thoughts. In a world where traders are bombarded with new indicators, fast-moving news, and endless strategies, it is easy to overlook the timeless practices that truly shape success. Journaling may not promise instant profits, but it delivers something far more valuable: a steady path toward patience, discipline, and self-awareness. Every time you sit down to write, you take control of your journey. You stop being a reactive player in the market's game and start becoming a deliberate professional. With each page, you reinforce the mindset that separates the disciplined trader from the impulsive gambler. So if you are serious about developing patience and discipline, do not underestimate the power of a simple notebook. Start writing today and let your journal become the quiet teacher that guides you toward mastery. Don't just trade with a strategy, trade with the right mindset. Subscribe to Trading Mindset Lab today and start mastering patience, discipline, and psychology, the 3 keys to becoming a professional trader.